Hello and welcome, Optuma users, to the next installment in this GoNoGo educational series. My name is Tyler Wood. I'm a CMT charter holder, and today I am joined by Alex Cole, the creator of GoNoGo Charts. How you doing, my friend?
Doing well, thanks. How are you?
I'm doing great. So if you've been watching and you understand the concept of blending multiple indicators to understand trend, let's move on from that and let's talk about the concept of momentum. But sort of the hallmark of GoNoGo Charts, one of the things that we drill into our own practice and talk with all of our institutional clients about, is the need to have a repeatable, disciplined process. Whatever your trading rules are, they should be the same in 2023 as they were in 2022. Obviously, the trades might look a bit different, but I want you to think about your emotions. Obviously, we want to avoid letting those decide how we make trade decisions, right? We don't want to fall victim to the behavioral biases and the powerful emotions of fear and greed. So we want to have a repeatable process that has a checklist with multiple tools that are going to guide our approach.
Yeah.
So Alex, why don't we talk a little bit at a high level about the concept of momentum?
Yeah. I think we know that once we've had a crack at trend identification, we're going to move to momentum analysis next. And that gives us valuable information about the velocity of price change. Momentum oscillators are indicators that we apply to the lower panels that help us identify areas of extreme price swings. We know that when prices moved in one direction really fast, that's quite significant. We could bet on a pullback in that idea of mean reversion, or perhaps it's the start of something that's really going to take us to new levels in a really, really strong trend. So we want to understand how these oscillators can help us looking for these extreme overbought and oversold levels, those sort of quick moves to up or down that can then allow or cause price to come back to the middle, or help us understand the strength of a trend. We can use these oscillators in the trend. But what we know from our work in GoNoGo Charts is that adding information in the form of new indicators, new panels, new lines to our chart can complicate matters and help us become almost paralyzed in our analysis. So we don't want to do that, even though we want the information from these oscillators.
Now, the important thing to know is that momentum oscillators are forward-looking, right? These are going to be our leading indications, whether they are confirming or diverging from price action. As we talked about in trend identification, that's by nature going to be a lagging indicator, right? The trend has to be established. There has to be enough data points and weight of the evidence to show that we are in a trending environment. So we're going to use the combination, the interplay between price action and these derivative indicators, the momentum analysis, to help us get better entries and exits for our trade decisions. So Alex, why don't we take a look at these one by one? I apologize to all of you in advance if we haven't picked out your favorite momentum oscillator, but we're going to walk through a smattering of these tools and show some of the differentiation between the way momentum oscillators are calculated. Why don't we start with stochastics, one of the most widely used and heavily traded?
Yeah, very, very popular indicator, of course, developed by George Lane in the 50s. And the calculation for stochastics is different from the others that we'll look at in that it compares the closing price to the closing prices of a range. So if the closing price right now is relatively high compared to the closing prices in that range, then you're going to have a high stochastics reading, right? Imagine if the closing price is the highest price that we've seen in the range. Well, that tells us that we've got some pretty strong momentum. So the way it's constructed is multiple lines. You can have more than two, but the two traditional lines are %K and %D. %D is a smoothing of %K. Now you can continue to smooth these lines and end up with more stochastic lines on your chart. But what having multiple lines does is it gives us crossovers. And that can be really important information. If the %K, the faster line, is crossing up over the slower D line, we consider that rising momentum, and we can consider that some sort of signal, traditionally perhaps to buy, especially if we're on these extremes of overbought and oversold levels. A crossing up signal from K and D when we are in an oversold level could be saying, listen, we're very, very extreme. We've moved down very, very quickly. And perhaps now, because momentum has turned up, we could look at that as some sort of mean reversion play. So stochastics are a very, very useful indicator. We typically set these overbought and oversold levels around 80 and 20. But of course, we need to know our asset classes. We need to know our indicators and our securities. And sometimes people will tweak those levels based on what they're looking at.
Absolutely. Let's do another really popular tool, also range bound between 0 and 100. This is the relative strength index, the RSI indicator, not to be confused with the concept of relative strength, comparing one security against another or an asset class. That's a totally different topic that we'll cover later. But the RSI was created by Wells Wilder and introduced to Wall Street in 1978. So just think back for a second about what the US equity markets were doing throughout the 1970s. It was a very difficult, range-bound bear market. And the idea of using RSI to find those overbought and oversold levels helped investors understand the concept of mean reversion. But as many of the great writers of our generation, Connie Brown, Andrew Cardwell, they continue to think about the practical application of these tools even within trending securities. So I want all of you to write down in your notebooks, an overbought level does not necessarily mean sell. That wasn't the original intention of Wells Wilder either, nor is oversold a signal to buy automatically. Trending securities can reach overbought extremes and stay there. That could be a very bullish sign for us. But let's talk a little bit about the construction. Different from stochastics, we have a single line, a single value, and that's just looking at a change in reaction from the latest price bar to a defined look back period. We're dividing the average gains by the average losses over that specified period, typically 14 days or weeks or minutes, whatever time frame you're using on your chart. Now we're going to see higher RSI readings when the recent price action has been dominated to the upside. So RSI, in a sense, is capturing market behavior, the attitudes and the experience of traders in the marketplace to help us identify those overbought and oversold levels that I was talking about. Now, it's going to help us predict, right, a leading indicator showing us areas of exhaustion or expansion in the price action, right? We're going to use that interplay. There's an important concept of divergence that Alex is going to talk about in more depth with our next indicator.
Yeah, the next one we're going to look at is the money flow index. And the reason we're putting this one in here is because this also attacks measuring momentum in a slightly different way. So the interesting thing here is that it incorporates volume. So this indicator will separate up days versus down days and then note the volume associated with each. So you can get a sense then of positive and negative money flow. So when the money flow index is rising, we can think of that as positive money flow. And when it's falling, we can think of that as negative money flow. Now, the concept of divergence that Tyler was just talking about is jumping off the chart here because we're seeing higher highs in price at this point, but lower highs in the money flow index. So what is that really telling us? It's sort of suggesting that on the down days over that period, there's more volume associated with them than the up days. And if you think about that, that's a bit of a concern if you are in an uptrend. So that's the important thing with the money flow index, that it incorporates volume to get a sense of market participation.
Absolutely. Let's talk about what is perhaps the simplest calculation, which is just a simple rate of change in price. And it's going to measure momentum by looking at that percentage change in price from the current bar to a specified look back period. Now, unlike the other oscillators that we've been looking at, the rate of change is unbounded, right? So typically we're starting at a zero line and we can move up to 100, down to negative 100. But we know that certain securities at certain extreme points are going to move well beyond any kind of normal range. Just to illustrate that point, for those of you who were watching in shock and awe at the meme craze, GameStop rate of change reached 1,800 on the rate of change during that historic 2021 short squeeze. So when we're looking at rate of change, we know that a rising rate of change above zero, so it's a positive value and it's rising, that's going to help us confirm what we're seeing in an uptrend in price action. Similarly, a falling rate of change under the zero line, right, negative territory, is going to confirm our downtrends. And one more note about that concept of divergence, right? We're going to use these tools as our leading indicators. but our trade decisions still need to anchor to price action. And what I want to point out is that those divergences can appear even in a false signal. So here we've got higher highs in price, and we've got a lower high in the rate of change, but that does not, in this case, precede a falling price action. It's not a trading signal. It's not infallible, at least. But what those leading indicators are going to help us do is sharpen our pencil, think about our risk levels, right? We're going to focus on what's happening in price action to see if indeed this trend is fully exhausted or if it can continue on further. So that's just a quick note about divergence. I don't want folks to take that away as a defined buy and sell signal.
The last one we're going to look at is the commodity channel index. Now, this one interests me because I think it gives you a sense quite clearly sometimes of how extended a price move is. You know, we talk about that a lot. I think price is overextended. But what does that really mean? The commodity channel index compares current price to its historical average. And we see a lot of people doing that visually on charts by just sort of eyeballing how far away is price from a moving average. And then they say, well, it's got to come back to its mean. And that kind of thing can be captured with this index. And with the commodity channel index, that's exactly what it does. Now, it oscillates above and below zero, but like ROC, it's unbounded as well. So we can get commodity channel index readings that go quite high. Even in this case, we're up around 200, over 200 for the S&P. So it makes it hard for us to successfully apply overbought and oversold levels. You know, it can be arbitrary. Where do you put it? Do you just put it at 100 and negative 100, which is perhaps what's most often used? But if you get a security where you've got a commodity channel index reading that's going much, much higher than that, perhaps that's not extreme enough of a reading to give you any kind of information. And of course, the concept of divergence applies here as well. You can often see falling highs on the commodity channel index when you've got rising highs in price. That would be non-confirming what we're seeing in price action. So a lot of the same concepts, but a slightly different method of measuring those price movements.
All right, so let's review very quickly. What we're talking about is a series of tools that are forward-looking indicators, and that interplay between what we're seeing in price action and trend can really be enhanced by looking at the concept of momentum. We talked about overbought and oversold levels and that concept of divergence, right? So pointing out those areas of potential exhaustion to a trend where buyers and sellers are not coming in with enthusiasm. The problem with these indicators is that which ones do you choose? They're all extremely valuable. They're all differentiated. Maybe we want all of these on our chart. We start to add analysis paralysis, as sometimes they are just redundant, other times contradictory. And certainly we're seeing that we are crushing this price panel into obscurity. One point that I want to make is that Alex and I are firm believers in technical analysis, and the work of George Lane and Wells Wilder and Connie Brown and Andrew Cardwell and many, many others is what has built this incredible toolkit for all investors to use. So we love these indicators, and we also know that the information is very important, but perhaps the way that we work with data visualization can help improve our analysis by reducing the amount of content on our charts and keeping our clear focus on price. So Alex, let's talk a little bit about the solution to that problem.
So here we are. We end up with the GoNoGo oscillator, which takes the same approach as the GoNoGo trend indicator. And that is by blending some of these foundational concepts of momentum into one oscillator, excuse me, that can be put on the lower panel that gives us all of that information that we're looking for, but perhaps without overwhelming our chart. So in this way, we can understand the velocity of price change, but we can also clearly see those areas of overbought and oversold. It works the same way as you would expect your favorite oscillator to work. You can see that when we reach peaks and troughs in the oscillator, they line up with peaks and troughs in price. Now, our oscillator is bound, and it goes from -6 to +6, so a very simple scale. So we look at areas of 5 and above as overbought and -5 and below as oversold. You can also quickly highlight divergence, just as you would expect and hope with any other indicator. You can see the higher highs in price here, the lower highs in the oscillator. And I think there's another example, earlier on in the chart where you've got lower highs in price, but with rising lows in the oscillator. So again, a change in momentum as price falls, suggesting that we may see price rally in the short term. Now, with all of the value from the information that we want and need from these momentum oscillators, we still want to keep our focus and our attention on price. And that's what we're able to do by keeping that panel large. You can look for things like important levels being broken. You can look for, that breakout recently above the horizontal resistance there was really, really key for us. And you can see it because there's nothing shrinking that price panel to the point that you can't read it.
And then, of course, as we saw with the money flow index, the importance of volume. Charles Dow, over 130 years ago, told us the weight of that confirmatory indicator to all of our analysis. We want to incorporate volume, but do we want to add another histogram or clutter our charts with yet another indicator in a lower panel? We have incorporated volume directly into the GoNoGo oscillator. So when you're seeing this green, we've got light volume. And when it turns to dark blue, we have heavy relative volume over that look back period. So it's going to give us that same weight of the evidence showing that there is market participation. There's heavy volume behind this upside move and the positive momentum that we're seeing supporting price action to the upside. So yet one more piece combined and blended into a single oscillator that's going to keep our analysis short, sweet, and simple to read. So for all of you, thanks so much for watching this installment of the GoNoGo educational series here on Optuma. If you have any questions, do not hesitate to reach out to Alex and I, info@GoNoGoCharts.com. Until next time, be well, stay safe, trade 'em well.